Let's be clear. Most of you, for sure, are underperforming the stock market. And when you pick a stock, you normally buy expensive, then it becomes cheaper, it ends up being a loser, or with luck, a mid-year fund. And this is not your fault, because if you go to professional fund managers, you will see that the same pattern repeats. So maybe if you are thinking, well, I'm not going to pick up stocks because I'm not good at that, but for sure, a professional money manager or a professional fund manager will achieve greater performance. I have bad news for you. No. As a group, they also deeply the stock. So trusting your hard-earned money to a fund manager or portfolio manager means that you have a 90% probability of underperforming the stock market. So this is not about skill. It is the nature of the game. Most stock pickers fail, most fund managers fail, and they fail not because they are stupid or because they lack abilities, not even to blame on their lack of psychological fortitude. Yes, psychology is very important, and we would see it in an episode in this channel. But even if you have ironclad will, very strong psychological fortitude, even if you have all the good psychological traits that make a good market timer or stock speculator, even though the nature of the game is that most probably your stock picks are going to be losers. And I'm going to share with you a piece of research I conducted with the help of ChatGPT. But I made sure it was not hallucinations, because what I researched with ChatGPT is the very same thing I already knew from my experience. So now let's go to my computer. So let's take a look at what ChatGPT says concerning the success rate of fund managers. Look here, and here in the conclusion, even a single year, roughly 2 out of 3 to 4 out of 5 professional managers lose to the index. So this is really encouraging. But look, here is the longer horizon, the worse it gets. So as ChatGPT says, this is where the data becomes devastating. In the medium term, 3 to 5 years, 67% of fund managers underperform over 3 years, and a whopping 89% of fund managers underperform the S&P over 5 years. And of course, if you take even longer term, let's say 10 plus years, it's close to impossible to outperform the S&P 500. So here's the key statistic. Fewer than 1 in 6 fund managers beat the S&P over 10 years. So really not very encouraging. So the research by ChatGPT is really humbling. If the pros underperform, what are your chances to outperform the stock market? Not many. So now let's see how we can turn the tables in our favor. So we have just seen that the odds are overwhelmingly stacked against your success in the stock market. In plain words, most stocks are not worth owning. And this is the ugly truth. Most stocks will underperform. Most stocks don't belong to your portfolio. In fact, 7 out of 10 stocks will underperform the S&P 500 in their lifetimes. So this means that the longer you hold stock, the more likely you will end up underperform. 55% of the stocks in their lifetimes will not even be cash. So your money in a bank account will make much more money than 55% of the stocks. Once again, I'm going to go to my computer and I'm going to show you a specific piece of research that focuses on the odds of a stock outperforming the index. The results will be mind-blowing. So I'm back to my computer and I will share more research from ChatGPT concerning the performance of specific stocks. Look here. Point number first. Most stocks underperform. So only 30% of the stocks beat the market over their lifetime, meaning 70% underperform the index. But watch out, point number 2, most stocks don't even beat cash. So it is unbelievable, but only 42.6% of stocks beat treasury bills, and more than half of all stocks deliver negative lifetime returns. So, as ChatGPT says, think about that. The typical stock is a loser. Point third says the market is driven by a tiny minority, so just 4% of stocks created all net wealth the US market. And the median stock return since 1926 is negative. And watch out, because averages may look a little bit better because you have Netflix, Micron, Nvidia, and other great companies that make the average look larger than it really is. But of course, the median, it focuses on the most frequent occurrence, which means that most stocks are really unable to achieve good returns. And then point fourth, even within the S&P 500, imagine now we narrow down the best of the best stocks. So stocks within the S&P 500. 60% of stocks underperform the index over time, and 75% delivered below average returns in some cases. So, as ChatGPT says, even inside the best companies, most still lack. And don't take solace in saying I am a long-term investor, because point five, the longer the horizon, the worse it gets. The median 10-year stock underperforms the market, and the distribution becomes more skewed over time. So it means that time does not diversify single stock risk. It magnifies, and this is vital. It magnifies. So, as ChatGPT says, the stock market is not a democracy, it's a dictatorship run by a tiny minority of owners. So, you need several items to be successful. First of all, you need market timing. I give you the links in the description section of this video to the episodes where I explain market timing. But secondly, you need rotation. What do I mean by rotation? You need to really have a very flexible portfolio that you buy stocks at the sweet spot, but you get rid of them approximately after 3 or 4 months of holding them. But of course, you cannot do this blindly. You need to know when is the right time to buy and when is the right time to sell this stock. To this you need a ranking system. In my opinion, the best approach that works for normal people, for the average guy like you and me, is that you have a ranking system based on factors. What's a factor? A factor is like growth, value, momentum, sentiment, you name it. So all these factors have been proven to work when one is patient. But of course, they have been proven to work in limited time horizons, not forever. So in other words, if you create a stock ranking system based on a combination of factors, it's like the grades at school. This stock is an A, this stock is a B, this stock is a C. And then you say, look, I'm going to buy stocks that rank A, then most likely you will outperform the market for several months. And then when to sell? Easy, it's very easy. Once your A grade stock drops to a B or to a C grade stock, then you say, look, I get rid of it, I sell it, and I buy another stock that now it's an A grade. It's very similar to school grading. So you buy stocks that, based on a combination of momentum, reservations, value, quality, growth, etc., they score high, and you sell them when their score is no longer so good. Of course, you will say this is easier said than done. And of course, you're right. I devoted many years to creating good ranking systems. But here's the good news. The first one is that in this YouTube channel, I'm going to explain how to create a good ranking system, what works, what doesn't work, more importantly, what specific factors blend well with other factors. For instance, spoiler alert, momentum does not fit well with value. You have to know how to mix, what are the proper weightings, but all these things I will teach you in the next episodes. The second good news is that I condensed many years of research into several episodes in this YouTube channel. So if you follow the next episodes, you will learn which factors work, which don't work, and how to mix them together. Another important thing when you use factors is that not all factors are creative. What do I mean by that? For instance, value means a longer time horizon so that you really see that their edge materialize. On the other hand, earnings revisions or momentum, they have a shorter lifespan. So for instance, if you are trading a system based on momentum, you will probably have to rebalance earlier. So if you, for instance, have a value-only ranking strategy, then you should give your stocks at least 6 months to see that the value is really manifested, realized in price. So it means your stock goes higher. So if you have a value strategy and you just give your stocks 1 month, this is too short a holding period for value to realize the full potential price appreciation of this stock. If you are trading value, your time horizon cannot be 1 month. You should give at least 6 months to your stocks so that price appreciation really matches the until now unlocked potential value. On the other hand, if you are trading a sentiment-based strategy, so based on earnings revisions, then your time horizon should not exceed 3 or 4 months, because earnings revisions are closely attuned to the quarterly earnings reporting. So it means that the ideal holding period will be around 3 months, give or take. And here is where most investors get it wrong. They mix different strategies or different factors with different holding periods. And of course, the end result is horrible. But if you know what to do, and I will teach you how, you will see that a good ranking system really has an edge. And furthermore, then you exploit the spells of outperformance that all stocks have during 3 or 4 months. So it is like surfing a wave. You take a wave, the stock is in a good 3 months spell of outperformance, you take the stock, you ride the wave, and when the wave is about to crest and go down, then your ranking system tells you that there is another good stock that is in the sweet period of outperformance. So it is like riding different waves and discarding the wave once the ranking system says that it is no longer an A-graded stock. Some of you will be thinking, hey, look, Warren Buffett and other legendary investors do not use ranks, do not use factors in a computerized way. And yes, you're right, but we must be humble. First off, we don't have the temperament, the personality of Warren Buffett, not even our origins. So we have to know ourselves. And at least I'm going to tell you what works. And furthermore, I'm sure not all of us have the talent of Warren Buffett. So it's true, while most stocks fail to outperform the market for a significant amount of time, which means that if you are doing buy and hold, you will lose money. It is true that people like Warren Buffett have the extraordinary skills to select stocks that have the ability to outperform the stock market for 10, 20, or even 30 years. But we must be humble. At least me, not all of us, have the ability to single point the specific stocks that have these 20 or 30 years potential of outperformance. So when we acknowledge our weaknesses, and I know very well which are my weaknesses, and even psychological ones, then we are best served by having a ranking system, so a strategy that indirectly is also based on fundamentals, because indirectly, a ranking system also dwells on fundamentals, quality, things like people like Warren Buffett keeps an eye on. But I use it on computerized base. So we take the data, the computer processes the data, gives me a ranking, and eventually it tends to be quite an agnostic process. Okay, so by now, I hope you will understand that the average investor needs not to emulate Warren Buffett, but to have a good ranking system based on sound factors. But this is not the end of the story, because then it means that you have to perform simulations. You must test. And I can tell you that most tests are not robust, they are overfitted. So many people think that they have discovered the holy grail of factor investing, only to have a badly overfitted strategy that will miserably fail when traded in real life. I will devote at least 8, 9, or even more chapters to the issue of robust testing, because this is vital. It is not only that you have discovered, oh, great, a system based on earnings revisions, your value. Now, you have to know how to test. And if you don't test properly, if you don't test for robustness, you will miserably fail. But this will be the subject in other YouTube episodes. And I hope that now you start to see the big picture. What happens if you mix a good stock picking strategy with a good timing indicator? Then you will get the best of two worlds. You will get stocks that have the sweet spot of 3-4 months of performance versus buy and hold, but when the stock market gets bearish, you will get out of stocks altogether. No questions asked. And this is what I do with my stock picking. So I have stocks that have an edge, but also I know when it's time to say no stocks at all, because my market timing system says it's not the right time to be in the stock market. In the next episode of this course, I will show you a practical application of what I mean. I will show you my Dow Theory for the 21st century plus high relative strength sectors strategy. I will explain how I mix a good time indicator like the Dow Theory with a sound stock picking, or in this case ETF picking strategy based on momentum, and you will see how I blend the two of them. The result is astounding, as you will see in the next episode. See you then.